My name is Adam Barron, and I'm a director within BDO's Growth Advisory team, where we specialise in supporting companies to raise third-party venture funding, be it debt or equity, across the UK. Most companies that we speak to are at an inflection point in their business plan, where they feel that the introduction of third-party funds will accelerate their growth. The backgrounds of our team are both that of advisors and former investors, which allows us to provide those companies that we speak to with an investor lens on the opportunity. To break it down, this means that everything we look at, we believe that we are doing so the same way that potential investors and funders would, thereby meaning that when a company approaches potential partners for funding, the opportunity is more likely to be one that appeals to them. We also have deep relationships with a strong bench of funders and investors, which allows us to both keep up to date with their mandates, as well as ensure that when we do show them opportunities, they will be viewed with credibility. There are a number of areas that we look at when we review an opportunity and get it ready for market. The first being the cash need of the business over the next 18 to 24 months. We look at what is a reasonable amount of funding to ask for now. The second, valuation. We question whether the investment can be split into tranches, thereby reducing potential dilution that existing shareholders may suffer. The third is the credibility of the assumptions that support the financial forecasts. We need to ensure that when a potential investor or funder looks at the business plan, it's not deemed to be too racy, but it is attractive enough to interest them. Fourth is that we reach out to a curated list of investors that we believe will be interested in the opportunity, so not to waste management's time with too many unnecessary meetings. Once offers of funding have been received, we use our experience to negotiate those terms to ensure the best possible offer, but also to manage the due diligence process, streamlining it for management and increasing potential for the deal to complete, whilst giving management back a bit of time so they can concentrate more of their bandwidth on continuing to grow their business. At the moment, there's been a lot of talk about the current economic environment making it difficult for companies to raise money. In our opinion, that is only half true. Funds still have the capital and they need to deploy it. However, valuation has decreased by about 30% since their peak in November last year. This has resulted in the need to ensure that a business is even more prepared in their raise strategy than ever before.